Good afternoon, rock stars. Hope everyone is having a wonderful evening, morning, day, in general, wherever you are. Very excited today. There's a lot of stuff, some neat stuff that we're actually going to go over here. And very excited to go over all of it with you. But I hope you're having a great day, great week. Hope business is going great for you. And I hope you're ready. I'm ready. It's time for your market update. So as you can see here, I'm repping my Movement t-shirt. These things are just so comfy. That's the best part about wearing them. But have to be able to give a shout out to my company. Also, you'll see here, one day we'll go over this. It's a clean slate board. You probably can't really see it because I'm on a recorded session here on my computer. So the screen's a little blurry, but a clean slate board is something that everyone should do, especially right now in this market. So what I'm going to do is I'm going to walk you through generally what I do when I'm obtaining market news and my own determination on what's happening in the market, because no one knows 100% of what's going on. You have to come up with your own determination and relate to your consumers and whoever you're talking to, any of your partners, on what's going on based on the information you've received, and then you're kind of summing it up and sending it out. Now, I'm not going to give you the full in-depth process of what I do, because there's stuff I do throughout the week, many other sources which would take hours, but we're going to go over the general good data sources for you to be able to peruse or browse once a week or once a month or whatever it may be, to come up with your own determination. So I'm going to go ahead and share my screen, and we're going to just jump right into it. So it's going to be a nice casual one here today. So here you will see my screen. So this is the first place where we're going to start. So I like to just go into Google. I type in fear and greed index. So this generally just tells you, based on the market, what are consumers feeling. So right now we're in extreme fear mode, extreme fear. So when things are really good, obviously we're in extreme greed or even neutral, and we were here, and then we slowly tick down all the way down to here. So extreme fear means people are not buying as much, or they're not going to, if they have stocks or crypto or whatever, maybe they're going to pull out. If it comes to housing, they're not going to buy. Many people are going to pull out from going ahead to buy a new home because of what's happening in the market and rates. They want to store cash, whatever they can do. So technically, a lot of people, based on this extreme fear, if you were a loan officer like me or other loan officers out there, I actually don't do this, and I should, especially with this market, which is promoting cash out, refinances, home equity lines of credit, home equity loans, because those are giving them cash to feed into the extreme fear. And that would position it to where they would say, okay, I want to pull out this cash to protect me and my family in case of a job loss or whatever happens because of what's going on in the market, what could potentially happen, because this is what's happening. Most of the country has extreme fear on what's going on, because let's be honest, no one really knows what to do about this inflation. We already established that the government has no clue essentially what they're doing. We're supposed to have these, very intelligent minds, and they do go about from a process standpoint, to some degree, at a higher level than we normally would. But right now, the people in place are not those people. So this current administration and who they have in place is not handling the situation very well. So fear and greed index, first place to start, extreme fear. That's essentially what I'm looking at. Which bucket are we in? I'm not really looking at this number, whatever. So now we're going to go over here. So this is the BLS.gov, essentially the U.S. Bureau of Labor Statistics. Okay, so BLS.gov, I'm assuming it's going to take me right. Same place. Okay, BLS.gov. So this gives us a lot of data, like tons of data. What's cool is you can actually look here on the right, and you can go through all of these great reports. So export, import, that's not like necessarily something that I'm going to look at. Productivity, I'm not really looking at that as well. Again, if you look at export and import, that could be for like oil and whatnot. So that would have some effect on the consumer price index for like oil. or something like that, or gas prices. But again, I'm generally not looking over there. If I look up here, employment cost index, this isn't terrible to look at. You'd be able to see here. So, total compensation of all civilian workers in all industries and occupations, 3-month percentage change. Civilian workers, total compensation, all occupations, blah, 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 blah. 3-month percentage change, current dollars. So consumer cost or employment cost index. So essentially per person, you'll see here the cost for a business owner to employ someone has dramatically increased. So here it actually decreased. Nice drop. So if you're a business owner, you didn't really like it right here. Here you enjoyed this nice downtrend, got down again, and you could just basically see, you just look from the trend. So boop, and then just shot right back. It's more expensive per employee. So that's something where a lot of employers are going to say we need to cut back because employment costs are going up. A lot of that has to do with pretty much income. So if income is going to increase, because like when inflation increases, you'll see, dollars per hour typically increases as well to meet that inflation as best as it can. Producer price, I'm never going to look at that. Average hourly earnings, again, you can kind of go here. Just look here, average hourly earnings, my apologies. Gosh, 553, and I'm already stuttering my words. Here, this was good, a nice little trend here, pop up, pop down here in 2020. Probably because of COVID incentives and things like that. So it's probably where we saw this spike to hire, like, for example, nurses. We'll pay you whatever you want in the world to come work for us, things like that. And then it kind of balanced out as well. So there's a good chart on earnings. Again, that just helps to know, like, what are people making. So we go over here, we don't need to look at payroll employment. Let's go up here. Actually, that actually might not be bad. I look at employment in a different chart. So this is a new one for me. Total non-farm, blah, blah, blah. All employees in the thousands. So this isn't pay. So this isn't like based on income. This one's based on actual employees. So stayed good. There was a shot down, obviously because of COVID, went back up, and now it's been okay. So it's not been terrible. We kind of stay on this line right there, which is good. Now, consumer price index. So this one's great. And actually, we're going to go over another section for consumer price index. But essentially, you'll see all items in U.S. city average, all urban consumers, seasonally adjusted. So the consumer price index is going to go based on energy. You're going to have like, food, gas, things like that. So if you look through here, blah, 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 kind of staying along this line, dip down, COVID again. And then, bam, ever since this election, boom, 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 boom. And this was actually a little bit prior to the election, again, part of COVID. So there may have been something that happened right there. But we saw kind of, again, this drop down from this high, and then it just decided to spike on up. We had a nice little drop here, which was nice in 2022 this year. Then again, it went back up. So let's go ahead and go over some better information for consumer price index. So really cool. This tells you exactly what it is. It is a measure of the average change over time in prices paid by urban consumers for a market basket of consumer goods and services. Indexes are available for the US and various geographic areas. Average price data for select utility, automotive fuel, and food items are also available. So we just look here, 12-month percentage change, consumer price index, selected categories, June 2022, not seasonally adjusted. All items right there, about a 9.1%. So that's really high, just so you know. So if you're looking at all items, bam, 9.1%, that's a huge spike up. Food increased 10.4%. Energy increased 41.6%. So that's like oil and gas, and then all items less food and energy. So we're going to go into actually see exactly what that entails. So you go down here, food, energy, gas, fuel, oil, energy services, electricity, utility, all items less food. This would be commodities, new vehicles, used cars and trucks, apparel, medical care commodities, shelter, transportation services, medical care services. So there you go. So here, I actually like this one. So this actually, all items, less food and energy. So less food and energy, again, commodities, new vehicles, cars, trucks, apparel, medical care commodities, shelter, transportation services, and medical care services. So all of that stuff generally started to go down, and then everything else started to go up. That usually happens in inflation. Whenever you see like this inflation kind of kick in and we're in a bear market, or you can call it we're in a recession. I'm full belief that we're in a recession like most people, but the full swing of recession is coming here shortly too. So we look up here, and once you start to see this spread, that's normal. It's inflation. People are going to buy less vehicles. People are going to buy less apparel, things that really don't matter. Now, shelter in that equation, that's obviously a big thing. So making sure you have your home in check. But outside of shelter, transportation services, medical care expenses or services, it's a little bit of a worry when these go down as well with it, just because that's our industry. And also, these other industries that are involved, their businesses go down as well. So that's where you see layoffs in those areas or those categories. So this split obviously is not a good indication for us in the real estate business because of what's happening here. It's okay for loan officers or lenders, because even if we have to lay off on processing and operations, okay, but we can take advantage of equity. So where you guys as realtors, you need to find a way to take advantage of equity. So how do we take advantage of equity? That is selling people's homes, getting them into a new one, because then, like I said before, they're going to be debt free. Or do a home equity line of credit, home equity product, cash out refinance, whatever you qualify for, pull out the cash now. So you're not contingent on a home sale. Get a lease agreement on the first one. Tell them they're going to lease. They're going to sell their home after they buy the new one. Bam, we covered the payment on the first one with the lease agreement. You can use 75%, or just basically we cover the PITI or any housing payment that's involved, including homeowners association dues. So that lease agreement will cover that. They got the equity to go ahead and put down on their new home. There's down payment assistance programs. We're rolling out a new one. Bam, they're covered. There's many ways to work around this. Even look into renovation homes. Homes that you can renovate, because again, that is going to be one of the number one products, and I will never cease to stop telling you that in the coming future. So again, this is a gap. That's an indication things aren't too good. So not good, downtrend. But hopefully this can curve and go back up. And then this one is curving up, and hopefully we can eventually see it peak on. And this one is it's going to continue to increase. There's no, don't think this is going to come down. And the only reason why I say that is because the way things are going, okay, we're printing so much money. We're raising the dollar insanely. There's a lot of talks that we're going to take like the dollar and make it a USD or an electronic currency. So we're going to switch from the dollar to electronic currency. May not happen tomorrow, may not happen in a year. I wouldn't expect that to happen, but in the future, we have indication that we're going to be an electronic currency, which again makes sense because a currency only lasts realistically somewhere between 40 to 60 years. So the fact that I think it's like 80 or something years into it, we did a great job with it. So there's that. Not to say we're doing a great job now, because we're not, but there you go. We're not gonna go over this. Okay, so we're gonna go back here, go over some other stuff. So let's go over, what's a good one. So I don't like to go over pay, that's fine. But let's look at national unemployment rate. Okay, so we can go through here. Federal employment rises by 372,000. Unemployment rate remains at 3.6%. Essentially, that's really all I need to look at is just this news release. Bam. So there was the most recent on 7/8. We can go ahead and do this. So you'd see Non-farm payroll employment rose by 372,000 in June, and the unemployment rate remained at 3.6%. So unemployment rate, see, boom, shot up. COVID started to slowly or quickly come down, and then as you can see here, it starts to balance out and it hits its kind of threshold. Non-farm payroll employment, seasonally adjusted. So again, shot down, and then we're recovering. So it looks like things are on this trend to recover. So that's good. That means people are working, which is what you want, even with this inflation and everything going on with this recession. It doesn't necessarily mean that a bunch of layoffs are coming, but we are creating jobs. And then you also have to consider the market and the economy and everything that's happening in the world. So if we take a look at, jobs that were in 1970 compared to jobs that are today, a large portion of jobs have gone bye-bye. So like coal mining, I mean, there's still coal mining in the world, but a lot of the American coal miners or mines are now discontinued. So those jobs went away. And now today we see social media marketers. So that's a job. So now there's new jobs. So what new jobs are we going to continue to see roll out for people to now go get employed in? So it just depends on what's happening, where are jobs needed, what jobs are created, things like that. So that is more of a news-driven thing, but it's good to be able to look at that as well. So not going to look at national employment because that's the data that we just looked at is essentially where I want to go. Okay, so there's that. Those are the only ones that we're going to look at in here. Again, I'm totally good with that. So this is a good chart just to show you over years of the consumer price index. So this shows you how it goes up, 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 plunge it down. Same thing, we're kind of balancing out on this downtrend, boom. So this, to me, looks like a normal kind of stock market chart. You're going to see, okay, cost is going up, bad times, bad times, bad times, okay, then bam, good times. But on a normal stock market chart, you have different markets. So in this market, it was, building. This would be a bear market. So in this time period, things were getting worse, 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 and then bam. In this case, things got better. If it was a stock market, like a stock chart or a treasury bond chart that we're going to look at, you would look at this and be like, okay, things are good, and then bam. And they normally do this. We call it like, this would be a head and these would be shoulders. So generally head and shoulders, okay, or we could also call it like this really doesn't make a flag, but like this would almost, I can't really make a flag on this because I don't have the chart tools, but there could be some sort of flag that could be created with this almost. So basically, 68% of the time when you have head and shoulders, you're going to have a drop, which 68% of the time, this is one of those times, a drop. So in this case, again, this is a drop for better. It's different than stock charts. So keep on going down, blah, 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 blah. Things are good. Things are prosperous ever since, this would be 1980, like roughly 1980, 1981, bam, and then you just drop. And so things are nice and cheap, 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 cheap. Love how cheap things are, blah, blah, blah. And then 2020, things start to go up. So again, this kind of puts us in this position. Are we going to do this? Are we going to go up and up and up and then drop? Or are we going to go up and then just drop? I don't know, but we've been in a very prosperous time as far as cost of goods and things like that since like 1981. So hopefully this can come down quick, and the next administration that comes in can help turn this around. So again, this one is New York Times, but all I did was I just Googled CPI report and this just popped up. So if you just again, generally looking here at a overall chart from years in the past, because then it gives you this nice array of data for you to look at. Next, I go here, so I have to be like, you have to actually like sign up for a membership. It's called MBS Highway. I believe it is only for loan officers. It's not for real estate agents or anything like that. I don't even know if you could fake like you're a loan officer. But when I'm going here, first thing I do is I go to the intraday chart. So I go to the intraday chart. What have rates done today? So I can look at here. I go all the way back from the morning. So you can see here, essentially this is where they were. And then essentially at 9 a.m., this is where they basically start. So this is where we start receiving pricing. So from yesterday, this is probably overnight. You saw that bump up, although this says 3 p.m. So that actually might have been at the end of the day. Then they shut down. So overnight, so down is bad, up is good. Okay. So if I go back here, everything shut down. So this was bad. So we woke up today saying, oh, shoot. And then this has been a fun day. So you'll see 9 a.m. generally a reprice here, reprice, like these are reprice times, these 3-hour spans. You can even go 6 hours, just go all the way back, same thing, but no, it's not giving me as much of a, there you go. There's a little bit better breakdown for you. But all right, went back up and we're like, oh, okay, things were great. Great. That's why we got a reprice for the better. So we had a terrible morning when I was pricing out rates. And then this morning, things were nice and pretty. So then they've kind of balanced out up here. So this, I don't know if there was news or what. So you can almost look to here. You can look here. So Mortgage Bankers Association released their application data, showing overall application volume decreased by 1.7%. Of applications to purchase a home were down 3.6% for the week and 18% year over year, which is not good. So generally you see rates get better when you see news like this, bad news. Refinances increased 2.2% from the previous week and were 80% lower from 1 year ago. So certainly they're going to be lower. No one's into the cash out phase right now because everyone doesn't want these rates. But at the same time, this 2.2% increase is an indication that people are saying we want to pull cash out of our home right now to tap into it because we are in fear or we want to be debt free. One of them. Consumer price index, we already went over that, but generally it was reported at 1.3% in June, which was above expectations of 1.1%. And increased 0.5% to 9.1% year over year, exceeding the 8.8% estimate. The CPI rate, which strips out food and energy prices, increased by 0.7% for June, which was above expectations of 0.6%, and decreased 0.1 to 5.9 year over year, which was above 5.7% estimate. Again, that's not good when you see an increase on the CPI, because that means the cost of goods are going up. So that's not good. So then we go over here. Stock, so these are just stocks to start the day, blah, 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 daily update posted. Stocks are down. There you go. Mortgage bonds have increased a little bit. This is typically what you see in this market is you see midday, like this is what you're supposed to see. Stocks down, market sucks, things are bad, mortgage bonds, they go ahead and they increase. That's generally what you see. What has happened thus far is not normal. You don't normally see inflation, bad stuff, horrible things, blah, 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 rates go up. It's usually the other way. When things are bad, rates go down. When things are prosperous, rates go up. So that's essentially how it goes because investors want to recoup their money. Investors are not recouping their money. So what do they have to do is they have to lower mortgage rates. And these are the people who are essentially setting the pricing, Fannie, Freddie, things like that, but all based on the actual US 10-year treasury bond and where the Fed sets their interest rates. So this just shows you again, as we discussed, this is where mortgage rates have been for the day, kind of stabling out right over here at this coupon, which is the 4.5. Now let's go to markets overview. So this will give you a much more in-depth chart. Okay, two things. One, coupon. Two, bond. There's some speculation on what this actually means, but they like to have it in there to show us. So coupons, there's 5, 4, 3.5, 4, Ginnie, UMBS. Okay. So when you see rates get really low, you see 2.5, 2, 3. So you want the lower coupon. Okay. When this goes higher, you want this number to get higher. This number gets higher, rates are going down. This number gets lower, rates are going down. Okay. So this needs to get higher. You want this to bump up. This go up, 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 up. This down, 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 down. We want you down. Stay down. So so this goes up, rates go down. This goes down, rates go down. Exactly as it is, inverse. Okay. So now we understand coupon bottom. So now we can go here and we can say, okay, let's take a look back. Boop, doop, doop. So how far back are we going? Let's do a 2-year. Cool. So in a 2-year mortgage coupon chart. Okay. See, blah, 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 blah. We're coasting up here. So this is September of 2020. Okay, so I don't think it lets me go back a longer time frame. I'd like to show you even longer time frame if I could. 3-year. Let's do a 3-year because 3 years are nice. So okay, so now we're back in 2017, so longer than 3 years. Okay, so June of 2017. So we were up here, things were nice, things were good, and we go down, and we go down, and we go down, boom, and we go up, then 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 we go down, then we go down, then we go down. So where we are now, super low, like super low on the chart, which means rates are super high. So again, we're going off of the coupon. So just showing you this particular coupon. I can even look at this one. It's okay, this one. This one might show you. It might be a little bit different, not crazy. Pretty much the same thing. Yeah, pretty much the same thing. So generally all the coupons are gonna have about the same style chart. Here you, again, down, up, down. So this is where we're at, this nice little spike. This spike just tanking, just tanked, okay? So now let's go ahead and, so now that you see where rates are, because again, lower is bad, higher is good. We can go up here and let's zoom it in. So came down, 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 boop, we had a nice little bump. Let's actually take it back a little bit. So here's where we had this, okay? So was it June 14th was the highest, essentially that rates were, June 14th. And then there was this nice little bounce up and it's come back down a little bit as well. So we just go over here, let's take it over here, further. So this is the lowest. Now we're right here on this line. So this is not good because we're bouncing down again. So it's kind of like this pattern of bounce, bounce, steep drop, and then bounce again. So when you have all these bounces, it's not good because that means we're just now just in this, bounce, bounce, bounce these little ones. Then we start to pick up steam and just bounce more. Okay, so that's just an idea of where rates are. There was a way that I could go back further. Max, let's see what Max takes me back. So I'd like to show you. I used to have the ability to show you even further back, which is insane. I think they got rid of it. Okay, yeah, so it's just showing you the max. So we're obviously way lower than we were in 2017. I would say this is more like 2008, 9 areas, probably a little more like 2009. But yeah, so that's just a general indication. This is the rate chart. Doesn't matter what lender you're working with. No one's priced out at 3. No one's priced out at 4. No one's priced out at 5. Everyone's mid 5s to high 6s, depending on product and a whole array of factors. As you know, there's a lot that goes into qualifying what rate you get. Loan level price adjustments from from Fannie and Freddie that are put in there if you're doing a Fannie or Freddie loan. So yeah, so there's a lot of factors, but again, rates, they just suck. So hopefully we can get them to come back up. Here's all the trends. There's all bad trends, bad trend, nothing good. So there's that. Now we're gonna go into the Census Bureau. So we're gonna go here. So full report, new residential sales. Just gonna look here. So look at new residential sales. You'll see here. So from May 2017, or I mean, sorry, not May 2000. So May 17th, 18, 19. So this just shows you what's actually happening here. So thousands of units. blah, 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 blah. The key thing I want to look at is down here. Okay, so this just shows you 2021, June, July, August, how many thousands of units that were sold. So there's 740,000 that were sold. And then over here we had in 2021, 696. So we are short on the homes that are being sold, new privately owned houses sold and for sale. So that just shows you that we're kind of down on home sales. Again, all from last year, down, 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 down. But these are still good numbers. Okay. So we might have a percentage of 10.7% down, but that's not terrible. That's not horrible to be. It would be one thing if we were, I'm sorry, from May to May of last year is negative 5.9. So negative 5.9, I knew there's something wrong there. Okay, so negative 5.9, that's not bad. That's really not bad. We're very close to where it is. These are still good numbers. So the fact we still have good numbers right now with this market is pretty incredible. And it's really throwing a lot of people higher up off because homes are still selling. So why are they still selling all of this inflation? Where are people getting all this money? Well, jobs are still active and they're hiring and things are looking good on the job side. So still have all this fear, it's greed, but we have jobs, which is a positive thing. And those are being created. So there's pretty much that. So generally what I do is I say, okay, what's kind of happening? What's kind of going on? Here's this data that I got. Sales are going up. Market's poopy. Yeah, rates suck. We are going down, we are going up, but are we going to turn? At some point, we're going to turn. You can't just keep going down. You can't just keep tanking. It's like that's never happened this bad per se. So the idea of us continuing to tank, probably not idealistic, especially with typically in a recession, you see rates go down because they need to infuse money into the economy. For what was it? It was like for every real estate transaction, it's like $148,000 that's like infused into our economy. So it's good. So ideally, you want to see those rates low, but if these homes are going to continue to sell, they're really not necessarily in a hurry, probably. That's the mindset that I'm kind of getting created based on this. Obviously, with jobs doing better, so that's a good thing. Unemployment rate stayed the same, so more jobs created and more people employed, jobs staying the same. And that's including the fact that the cost of employment has increased. So if you have an increase in the cost of employment as well. Amidst all this fear that's going on, which again is not good, but it just definitely shows that no one has any clue of what to do and what's going on because this is clearly uncharted territory. So based on this information, other information I see and I hear and I attain throughout the week and weeks, we are, in my opinion, in a recession, and we are going in. Whenever we're in a recession, it doesn't mean the whole world or the whole country necessarily knows we're in a recession. It's just kind of speculative. And are we in one? Are we not? So my speculation is that we're in a recession, and that we are going. The government will release that we're fully in a recession, and they'll adapt it, and people will think, oh, we're in a recession now. And when that happens, you'll see rates recover. The question is, are home sales going to continue? And this chart is very promising. So I would say home sales should still continue. The only reason why you see this drop probably, so if we look here, so, well, actually it's only going for 1 year. So it is what it is. I was going to say like, maybe if we looked at, prior months, like April, May, but that's not in this report. So since that's not there, can't go back. But these numbers, even in comparison to these, January to May, 831 to 740, growth. June to February, 790 to 714, growth. 715 to 726. It's a descend, but it's not that much different. 629 to 686. not terrible. 696 to, what is this, 732. Again, all good. I would say they're just going down because of rates. So a lot of people that were qualified no longer qualify. That tells me that, hey, it's just interest rates. People still want to buy homes. And if jobs are still going to be coming in, we should be good. We should be good on the home front. So you as a realtor should feel very good about this. These are strong numbers to be posting. You could look here at the Midwest and just take a look at this data. So 102, that's, January, there was more homes sold in the Midwest than any month from May through December in all of 2021. Holy moly, that's incredible. 89, strong number. 87, strong number. There's only an 85, a 95, and a 92. So 2 months in the 80s, 71. Again, a lot of numbers in the 60s and 70 and 55. Like, that's a strong number. 58, yeah, that's not great, but you also see a 55 here. So is the next month going to be 55 or 54, or is it going to be around that same? Again, that's not terrible. So again, you're seeing a 30% decrease because it's 58 to 92, but compared to all the other months, these are pretty good numbers. And right now, this is May to May, but you generally look over here and you start to see, kind of October, November, December, things generally go down. So we're going to anticipate that this number 58 is going to go down, but hopefully, things are going to pick back up like it shows here in January, February, March, all good numbers. Even 71's good. You saw May, good, June, good. So all of these months are good, and generally lower in the summer and lower in, that carries on over. So I think that's good information. If I'm a realtor, I'm saying, hey, homes are still selling strong, which is great. There is one other, let's see if I can pull it up. Where's the NAR? Google. We're going to go to NAR. Sales there. So NAR does give a good, here you go, housing statistics. This gives a good housing shortage tracker. I kind of like this one. This one, so if we look here, you can actually see here. So essentially red, housing shortage, blue, sufficient supply. So depending on where you're at, okay, so Indianapolis, Carmel, Anderson, for anyone there, we're going to be looking, we have sufficient supply right now, which is good. That means we can be selling homes. So if we have buyers, we should be taking them out. But then you look over here, a lot of people are moving to Florida, California. There's definitely a shortage of homes. Maybe people are moving back out to California. I don't know. In some of these other areas. But generally the Midwest, people move into the Midwest from New York and some of these high cost areas like California as well. But we also know a lot of people are moving into Florida. So this also could be affected by the standpoint that rates have gone up and there's just a lot more buyers. So now it's, essentially a turning into a buyer's market. I still don't want to say a buyer's market, but it's generally turning into there. They didn't mean to highlight that. You can actually do, let's see, single family permit. That's where I was. I don't know what permit total units is, not sure. Apparently there's sufficient supply and total units permit, whatever that means. But this is the one that I go off of, single family unit permits. Cool. Or permit or whatever. Cool. So a lot of good data. That's generally the information you want to take in and say what's going to happen with this market. As you can see, me nor anyone is like 100% assured of what's happening. It's impossible to say I'm 100% sure of what's going on, but at least you have information and sources of data that you can go look into and come up with your own determination. Now, I would suggest listening to all areas of the economy. One thing that's good is listening to people who are stock traders, cryptocurrency traders, things like that. That's just because they're getting information about our economy as a whole. They're not just getting information about crypto, because everything affects everything because of its news. Okay. So when you look at So for example, cryptocurrency, like that itself does not affect mortgage rates, but the news around it could affect mortgage rates. So things that are happening, in other words, what are people doing with their money affects mortgage rates, not cryptocurrency, prices or those charts, for example, or all that stuff, or a specific stock in general. Those don't affect mortgage rates, but economic news affects mortgage rates. What is going on with money? What's happening with people's money? What are they doing? Are they making money? Are they losing money? Is the cost of is the cost of goods going up and the dollar depreciating? Like, what do we have to do? And then these products, mortgage products, real estate, they have to come in and help with the side of those products. So like if things are going up, they want this stuff to go down. They want mortgage prices to go down. They want home prices to go down. Why? So that people can buy and infuse money back into the economy. So that's why the idea of the Fed inflating the Fed rate, the Fed inflation rate, okay, to be able to hopefully have consumer prices go up. And as those prices go up, then they're going to go ahead and say, okay, people are no longer going to afford as much home. So with the current home prices, so hopefully they will come down. Unfortunately, they really haven't. So that didn't really correct it. It just means less people qualified now. And so less homes are being sold. But with all the indications is that we still have enough people buying homes. Now, the number may be a little bit lower right now than what we like, especially going into months where they typically get lower in October, November, December, that back to school kind of area of the year. But still strong news. The fact that homes are still selling and they're still selling at list price or above is incredible. So that just shows, again, consumers are wanting to buy homes. We are still in a purchase boom. I still say it's a seller's market. This may be a temporary buyer opportunity, but is it? Think about your buyers, okay? Would you rather have a 3% interest rate on a $400,000 home or a 6% interest rate on a $300,000 home? Of course, the $400,000 home. In fact, that payment's probably going to be cheaper than the $300,000 home at 3%. The $400,000 home at 3% is going to be cheaper on a payment, or at least comparable to a payment of $300,000 at 6%. So of course you want to see them in that. The idea right now is, hey, buy the more expensive home and you'll refinance. What if they don't qualify? So again, it's maybe you can call it a buyer's market or a temporary buyer swindler market, but it's really not. I think low rate markets are buyer's markets. I don't consider them as sellers markets, because the buyer, there could be tons of buyers, lack of homes, but if more buyers can buy more homes at lower interest rates, they're happier. They can do more, they can buy more. And so their portion of interest is actually less. So from a financial standpoint, you want rates low, as everyone knows. And so you have a lower rate, you buy more home. That's all good stuff for a buyer. A higher interest rate at a lower purchase price, that's not really a buyer's market. It's just on a negotiation standpoint for a realtor that helps, negotiate and do some wiggle room if homes aren't selling. But I think we're still in a buyer's boom and will be for the next 10 years. We're just in this temporary period. And so all the news indicates that based on what I see. And jobs are still good. So that's also a good thing. You just got to look out for what are those jobs, and are there new jobs? Like, what are the new jobs that are being created? So what is happening in our world? Where do we have to adapt our business models to meet those demands as well? So I hope you enjoyed this. Again, a lot of information, a lot of data. I'm going to go ahead and stop sharing my screen. But again, I hope you enjoyed it. Hope you were able to pick up a couple nuggets. Hope that you actually go in and utilize these sources of data. So these websites, to come up with your own determination. Don't expect that these people in the market know what they're talking about. They really don't. They may have more, like, you may find someone who obviously has been watching things for years, so they have a little bit better knowledge or maybe some insider info. But for the most part, it's all predictions. So if everyone's predicting, all the higher up, the really good guys are going to tell you, come up with your own decision. We're giving you the information, we're giving you the data, but you come up with your own strategy. You count your steps. You do what you have to do, because we are not you. We can't just dictate to you, do this, because there's a chance that everyone could be wrong, and everything we're seeing is great. We're obviously in an uncertain market. Things could just skyrocket and just say, screw it, we're going to leave it up here for a long time. That could happen. And so again, this is not like 100% foolproof. This just shows you how to kind of come up with an idea of what's happening in the market on your own. So again, hope you enjoyed it. Enjoy your day, enjoy your week, and thanks for tuning in.